So right away, we have relative equal lows here. We have a buy side imbalance, sell side inefficiency. We have a bullish breaker, last up close candle here. And mainly the imbalance right there. Okay, so watching this low right down here, that's, well, not low, but that high rather, that's what we're going to focus on, that would completely close in this buy side imbalance. So what are we looking at? What are we seeing here? What we're seeing is the initial stages of a high resistance liquidity run, even though the market is bullish. Why is it high resistance? We had a market trade high here, then a higher high, then a higher high. So we had basically a three Indians pattern. All the highs are successively higher. So this was all running out liquidity, specifically seen as a return back to this displacement right here. So it returns back to rebalance, but don't lose sight of this signature here because this is high resistance. For now, just know that this buy side delivery, it's running price higher, going to buy side liquidity here, but it's offering buy side delivery, running into buy side liquidity here. That's why sometimes when you hear me talk about, okay, it's going to run to buy side liquidity or relative equal highs, they assume erroneously that just because it runs above that, it's running out stops to go the other direction. No, you have to know what you're doing. You have to be able to read price and know what it is that price is doing. This buy side delivery, it's imbalanced. It's only been offering buy side, so it has not offered efficiently any real opportunity for sellers to trade short or offer in this range between the high here and the high of this candle, what's being highlighted with this blue line. Each high here, we have buy side liquidity here, it runs it. This high here has buy side liquidity, which it runs it as well. And then it breaks down. What's actually occurring there? This is a shift in market structure. It is not a break in market structure. Okay, it's just shifting within the context of an underlying buy program. So this low, when it was broken right there, that shifts market structure to bearish, but only on the near term. Why? So it can go back down below this low to rebalance this buy side imbalance. Before it trades down there, it trades back up into a premium fair value gap. Once it rebalances that, then it's okay to see it trade lower. It trades down into that old high, which is retail resistance turn support. Does it rally? It gets a little sputter there. Then it goes a little bit lower, goes up one more time, and then drops aggressively here. So what is this occurring? It's offering a run on the liquidity that would be engineered right below these lows. But price trades down into the imbalance and then runs higher. Trades above this high. There's your short-term shift in market structure. Now, I don't have it identified like it does here, but this is a shift in market structure to the bullish side. What's different about that? This is short-term down to a discount. This right here is a change in the state of order flow. So there's an algorithmic transition from buy side, the market's offering buy side, and then it goes down into that buy side while it's acting as sell side. Okay, so there's a change in the state of delivery in the price where it was offered on sell side here into an area where it was only buy side. When you have that happen and the narrative is bullish, this is where the signals form. This is how you quantify the buying opportunities, whether it be a breaker, whether it be a fair value gap or an order block. The fact that the algorithm is going into an area where the state of delivery is changing to a previous state of delivery. And it's basically saying this: where there was buy side offered only, when it drops into that as sell side, that is what keys up the algorithm, and it matches up sell side delivery in an area when there was only buy side. Once that occurs and the narrative is bullish, that's when price will change on a dime and start going up. That's how you've been able to see me do these examples where I'm recording and I'm buying and it's turning right on a dime and it has very little drawdown. I'm teaching you that right here. That's what this lesson is. I'm teaching you the internals of why order blocks and imbalances constitute a setup. It's not just it's trading to an old candle. There's logic behind that. And you have to know what it is that it's doing. It's not just simply, oh, it's going back to the order block and we'll just keep it simple. No, the fact that it's got an imbalance here, why does it need to go down there anyway? Because this is efficient delivery of price, and this is what traders are looking for. They are not buying this and then driving price up because they bought it. The algorithm is already going to go up from this point here. Traders on an institutional level may miss this opportunity. That's the part you don't understand. What I'm showing you right here is the internals of what makes that algorithm do what it's doing. How does it reprice higher? Once it does its job of rebalancing the buy side, once it does that, as it goes into sell side. So it's basically saying this: the candle goes up on one singular candle. That's not efficient. But look what's doing here. It's going down multiple times, okay, in a stage where it goes down a little bit, consolidate, down a little bit. It's offering and spending time down there where sellers were being offered the opportunity to get in there. Why? Why would they want that to happen? Why does the algorithm program to do that? Because traders are going to see this as a bear flag. They're going to want to go short, okay? They're going to sell more. Not just the sell side liquidity here, but they're going to flood the market in all of this because they're going to chase it, thinking it's going to drop lower. So they're pushing all kinds of traders' sentiment into thinking it's bearish, 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 when it's nowhere near bearish. It's all bullish. So you have to look at the contrast between what is the imbalance and how does it trade there. It changes its state of delivery, not a singular one candle down like it does here. It's doing something. And you have to think about, what is it doing? It's putting in more sellers. And once it does this and rebalances, the algorithm is not aware of how many people bought or how many people sold. It doesn't know that. It doesn't know your specific stop. They don't have that. There's no book like that, okay? The idea is everybody's stop is going to be where everybody's stop is, because everybody's drinking from the same pool and the water's tainted. Price starts to reprice higher, and it cues all the traders that will be waiting for this signal here that is aware of what the algorithm's doing. Once they see this break here, that's a shift in market structure on the bullish side. Now, again, what changes? We are now in alignment with the buy program after it's been rebalanced and overcome this impulse of sell side liquidity. It's been flooding the market here on two levels, with buyers trying to buy here and they run at, or they go down and then go down again, rebalancing this buy side area here. So it's not like usually you expect like a single up candle and then over here a single down candle and it rebalances. It can happen that way, and that is usually a consolidated range environment where it'll rebalance like that. But generally a strong trending market, you'll see something like this many times if you drop down lower time frames and you look inside this imbalance. So what may not be showing on a hourly chart here, this same thing could occur in a 15-minute chart where it drops and then drops again. So it's giving a trap, basically, for traders that want to chase it going lower, thinking this is a bear flag, and they're going to look for it to go down in here or maybe into these levels or this old low.